The actual Ponzi that makes strategy work is the fiat system, with the government issuing more and more debt and repaying interest on previous debt with new debt. So it's this money printing and devaluing of the dollar that is actually making Bitcoin more valuable and making strategy work.
Are you all in on the chair? How many chairs are you sitting on right now?
Hello, everyone, and welcome to a short episode of One Chair. Today, we're going to cut through the noise around strategy and its Bitcoin treasury playbook. You've probably heard a lot of the criticism that they are over-leveraged, that they'll get liquidated or margin called, that it's a Ponzi scheme, and how can they promise a yield on their preferreds if Bitcoin yields nothing. So we're going to talk about all that and separate fact from fiction. So let's dive right into it with myth number one, that strategy is over-leveraged. If we look at the data, strategy today holds almost 640,000 Bitcoin worth $73 billion as of September 15th. And their total debt, which is all convertible debt, is $8.2 billion. So this translates to a debt to asset ratio of 11%. And if you count the debt that is already convertible into shares, the debt is actually only $5 billion. And the debt to asset ratio is reduced to 7%. So looking at that, strategy is definitely not over-levered. This leads me to myth number two, that strategy will get margin called or liquidated. Now, again, if you look at strategy's debt, it is composed of convertible bonds, and these bonds are not collateralized. And this means that there is no margin call or liquidation price on this debt. The debt has a maturity date that is spread between 2028 and 2032, and the repayment is in cash or in stock if the bonds are in the money. And as of today, what does this mean? It means that Bitcoin would need to fall below $13,000 by 2028, and it would need to stay there for a prolonged period of time of 3 to 4 years for strategy to get into trouble. And this would mean that Bitcoin would need to fall over 90% from its current prices and stay at those very low prices for a very long time. And this never happened in Bitcoin's history. And basically, if you bet on strategy, you bet on the fact that Bitcoin will appreciate in value over time and not go down by that much. Even if it does, however, if tomorrow Bitcoin crashes to $10,000, as long as it recovers over the next few years, strategy is still fine. So this leads me to myth number three, that strategy is a Ponzi. And here the main argument is that strategy would need to sell additional preferred shares to pay the dividend on their current or on their existing shares. And this is not necessarily true, because strategy actually has multiple different ways to pay the preferred share dividends. They have free cash flow from their operating business that they could use. They could issue common stock, preferred stock, or additional convertible bonds. And this all depends on the market environment and what makes most sense at that time. Now, if the market is really bad, they can also temporarily suspend dividend payments. But I think the most important point here is that strategy has $73 billion worth of Bitcoin on their balance sheet. They're good for the money. They actually have the assets. And as a last resort, strategy could also sell Bitcoin to pay those dividends. And if you look at the liabilities that they have for those dividend payments, today it's around $400 million a year versus the 73 billion in Bitcoin that they hold. So even if Bitcoin was to fall by 75%, they would still have enough to pay those dividends for many decades. The actual Ponzi that makes strategy work is the fiat system, with the government issuing more and more debt and repaying interest on previous debt with new debt. So it's this money printing and devaluing of the dollar that is actually making Bitcoin more valuable and making strategy work. Now, myth number four is that the Bitcoin has no yield. And this is true if you mean that Bitcoin doesn't produce additional Bitcoin like the dollar would. But what's important to understand here is that strategy holds Bitcoin on their balance sheet, and all of their debt and dividend liabilities are denominated in dollars. And Bitcoin has massively appreciated against the dollars over its whole history. If you look at the lowest compound annual growth rate of Bitcoin over its 13-year existence was 25% per year. So this is far above the typical US Treasuries at around 4%. So if today you were to invest $1,000 into Treasuries, after 10 years, you would probably have around $1,500. If you invested in Bitcoin instead, and let's take the worst case of 25% CAGR, you would end up with over $9,000 in Bitcoin. And this is MSTR's preferred strategy, is to borrow dollars today at the cost of 10% a year, the dividend payments that they need to make, buy Bitcoin today, right away, with the money that they raised. And then it's a bet that Bitcoin's growth rate will exceed those 10% over a long enough period of time. So the bottom line is strategy isn't over-leveraged. In fact, they are 9-to-1 over-collateralized with the Bitcoin they hold versus their convertible debt. There is no margin call that's coming because all of the debt is uncollateralized. If you believe Bitcoin's long-term CAGR will stay above 10%, then strategy is a very strong bet. And if you think that Bitcoin will crash under $13,000 and stay there for many years or even go to zero, then obviously strategy is not a good bet for you. Now, none of this is financial advice. It's just the facts and figures. Thank you for tuning in and see you next time. Bye-bye.
How many chairs are you sitting on right now?